A very good evening. Welcome. You're watching a special telecast on Crude Reality. World's largest oil producers, as we know, are meeting in Algeria starting today all the way till 28th on the sidelines of International Energy Forum to discuss the most important issue. Will there be a production freeze this time round? Well, there have been multiple OPEC meets this year, two actually, one in Doha, and there has not been any agreement reached so far for any kind of a production freeze. We have a special panel lined up for you to discuss where this particular commodity could be heading, what kind of factors are at play right now. We've got Vandana Hari joining us from Vanda Insights. Apart from that, Ged Davis would also be joining us, and from London, Emma Richardson is there on the show. Gentlemen and ladies, thanks a lot for joining us. Vandana, let me start with you. What are your thoughts? Ahead of this particular meeting, crude oil prices have become extremely volatile. What significance would you assign to this meeting?
Good evening, Ajay. I, like a lot of the other market watchers, had been quite dismissive of this meeting, but I have changed my viewpoint slightly in recent days leading up to the meeting. And I'll tell you why. The reason for that is I see that a lot of diplomatic push and activity has picked up in the last few days with the host Algeria, as well, of course, Venezuela, that has been asking for some kind of an OPEC action for a long time, stepping up their efforts. Now, that's not to say necessarily that this will yield something, but I have a feeling that OPEC is now very close to a credibility crisis. They're not just in revenue deficit, I would say it's credibility deficit for OPEC as well. And if they come out of this meeting completely scattered and with no, I don't expect a decision, but with not even a way forward, I think they're not going to be taken seriously for a long, long time to come. So a decision, probably not, most likely not from this meeting, but I think the pressure is there on OPEC to come out with something very concrete and credible. Whether that is a freeze, that's an output ceiling, or a cut, I think that remains to be seen. The ministers are going into the meeting with very diverse viewpoints, even conflict of interest. So I don't think something like this can be resolved even in a couple of days. Probably my expectation now is they'll make a start and want to continue those discussions at a later point of time.
Right. Ged Davis, what are your thoughts on the significance, in fact, the change in stance by some of the players in the last couple of hours? Even Vandana was talking about how commentary in the last couple of hours is making her change her view. What is your broad picture observation before we start discussing the specifics?
Yeah, well, for me, what is important about this meeting is that one will get a sense of the appetite of OPEC members for cuts. So in that sense, it's important. But I prefer to look at this in perhaps the larger picture. We are in the early years of a new price regime. I don't like the word low oil price era, but I would remind us all of where we've come from and what we've seen since the first oil shock. We had a period of 13 years where oil prices were 3 times the price prior to the first oil shock. And when they collapsed in 86, we had a regime that lasted beyond 2000, with oil prices at around, on average, half the price of the period before. They then rose until 2 years ago to a point where they were 3 times the prior period. So what we've seen are quite big shifts in regime that take place variously between around 10, 15 years. Now we're a couple of years in, and this meeting is important in the short-term context, but as we may well want to discuss, it doesn't fully tackle the big issues that are going to shape oil prices in the coming few years.
Ged, you bring a very different perspective to the table right now. You've been an oil man yourself, working for prolonged periods in some of the best companies across the world. Talk to us, how are these companies planning their capex going ahead? Because they also do some pretty decent forecasting or estimates of where the demand-supply gap could be heading, isn't it?
Well, I think the starting point, and it may be no surprise to people, is regardless of how good you think you are about looking at the future, the number one thing is to get your asset structure right in the present. And as we've seen, you look at some of the Wood-Mac analyses, which are always interesting. Large cutbacks in exploration, carefully rethinking some of the larger projects, maybe reshifting assets from oil and looking at gas as having potentially a larger future. I think quite a number of the companies in practice are hunkering down for a relatively low price environment over the next few years and essentially getting their cost structures right and so on. Now, I think longer term, let's be very clear, the market always turns because of the fundamentals are very simple. Oil demand rises when oil prices are low. We can talk about the particular current situation if you wish. And equally, it's true on the supply side. We eventually trim supply to meet what hopefully will be a growing demand. And the market shifts and turns fundamentally.
Vandana, you just mentioned that there seemed to be some amount of pressure building in on OPEC as an organization to do something about excessive supply. And now we've already seen 2014, 2015 were years of extreme supply, and the demand was on the lower side. For the next year too, early estimates indicate that non-OPEC and would continue producing 350,000 barrels. Or I would say, what would your observation be on the automatic adjustment next year, over and above any kind of agreement on production?
See, when OPEC took that rather controversial decision back in November 2014 that they would just let market forces do the work, they expected that lower prices would bump up demand, especially in the growing economies in Asia. And they expected that lower oil prices will curb a lot of the US output. Now, both of those things happened to a certain extent. They happened much more slowly than OPEC had expected. So we have seen US output go down after nearly 3 to 4 years of relentless growth in US production, close to 800,000 to 1 million barrels per day that the country was adding. For the first time in 2016, their output is expected to be nearly 800,000 barrels per day lower, and probably a little bit even lower going into 2017. If you look at demand, I think that has puzzled a little bit and surprised quite a lot of the industry as well as watchers, analysts, because the simple economic theory was, of course, when oil falls from above 100 to $40, $45 levels, demand should go up in tandem. But we see that hasn't happened. There's been a lot of economic headwinds, especially in Asia. And we have seen a lot of the demand growth that was coming from oil producers. So we have African countries, we have Latin American countries, we have the Middle East. Now, obviously, their economies are in trouble. We've seen Russia and Venezuela in recession. Nigeria has just also gone into recession. So some of these things were not anticipated. The sum total of that is today we are sitting in a I would say, an uncertain world when it comes to demand growth. It's not a given. There are varying estimates of how much demand should grow this year. I personally am quite pessimistic. I think the IEA is expecting about more than 1 million, 1.2, 1.3 million barrels per day increment in world oil demand this year. I don't see that happening. They expect nearly 900,000 barrels per day addition to demand in Asia. If you look at China, the oil demand growth has been flatlining. So China is going to add very little. India is growing very strongly, 7 to 8%, but from a very small base. China consumes 11 million barrels per day. India consumes just about 4 million barrels per day. So overall, I'm quite pessimistic on when it comes to demand growth. If we leave the world to rebalance purely on the basis of demand, I think it's going to be a very long drawn rebalancing. So there is definitely a very logical reason and impetus for OPEC, Russia to do something about supply if they want to hasten the rebalancing in the market.
Right. Ged, what are your thoughts on the way US rig count continues to rise, however gradual, in the US region? Even for the week ended September 16, there was increase registered. Not only that, the shale production in that region is also not really going down in a very major fashion, because some people believe that select regions of US it may be profitable to continue with the production in shale. How are you looking at the activity in that region?
I think we would be quite strong believers in the surprising flexibility of US tight oil and the improvements in productivity. That's behind this relatively modest decline compared with expectations a year or two back. And it really puts the Algiers meeting in context and just how distant we are from getting a real solution to the present situation. For me, Algiers is about talking the talk. To get a credible outcome would be strong and clear statements about reducing in the coming year production levels, whatever they may be reduced, and shared amongst parties and hopefully involving Russia. And that is really just an opening to the next stage, which is almost walking the talk, which is to take that and to actually move us towards a rebalancing within a year or two. But that is only part of the way, because the really big challenge is walking the walk. Once you've actually got some degree of supply demand balancing, is to then fully address the high inventory levels which overhang this market. And then how do you handle, as oil prices, if they were in fact to begin to rise through the 60s and 70s, how do you stop large-scale comeback of tight oil and other non-OPEC oil? And that's quite apart from the issues of Libya, Nigeria this year, and so on. So I think going from talk the talk credibly to walk the walk is an immense challenge for OPEC. And I think we'll all be looking to see how they begin that journey.
Ged, I would actually like to scratch that point a little more, but another expert panel is joining us. Vandana, I'll let you go on that one. Thank you so much for your time. Hari Tchilinguirian, Head of Global Commodity Markets at BNP Paribas, is also joining us on the phone line. Hari, Ged was talking about how difficult it is, for all these large countries, of course, to arrive upon one particular level. Talking about it is a separate thing, but actually walking the line is a completely different kettle of fish. What are your thoughts on the significance of this OPEC meet? Do you think we are coming closer to any kind of a production agreement?
Hello. Yes, I totally agree with what was just said. I think ultimately when you look at the various OPEC countries, they all have different agendas, and these agendas are definitely not aligned. So if you look at a country like Iran, they're seeking to increase production to pre-sanction levels, whatever that pre-sanction level may be, 3.6, 3.7, and in the eyes of the Iranians, 4 million barrels a day. The Saudis are not willing to participate in a collective deal unless the Iranians agree to freeze production, which isn't going to happen. Iraq is seeking to expand capacity, and countries like Libya and Nigeria, if given half a chance, would reinstate production that has been compromised by domestic unrest. So it's going to be very difficult to find a middle ground that would bring all these producers together into a collective solution.
All right. Gentlemen, stay with us. We'll take a very short break. We'll come back with more panelists joining us on this discussion, which is just getting warmed up. We'll talk about the role of each large player right now and the stance going into this extremely important meeting. The confusion, of course, coming in from Saudi Arabia and the conditions being put. How does Russia play their part? That's the only non-OPEC member which is attending this meet. We'll discuss all of that when we return. Welcome back. Still watching a special telecast, Crude Reality, as we actually expect a lot of volatility in crude prices, given the fact that there's a 3-day meet in Algeria. The OPEC 14 members are meeting to discuss possibilities of any kind of production agreement on their levels in order to arrest the fall in crude oil prices. Our panelists are with us. Harry, I was just wanting to speak to you about the role of some of the large non-OPEC members. The only non-OPEC member which is attending this conference or meet would be Russia. And at about a fortnight back, they had indicated that they too are quite keen if some kind of agreement could be reached. Their oil minister Medvedev had indicated that. How do you analyze the stance of Russia in overall scheme of things?
Well, as Winston Churchill used to say, they're an enigma wrapped in a riddle, et cetera, but in the end they do what is good for Russia. So, of course, if other producers freeze production, naturally Russia has a keen interest in having that happen. In the end, when you look at the latest Russian crude oil output figures, or oil and condensate, they have hit yet another record high. So, in as much as Russia may be egging the rest of the producers to come to a solution, in the end, its own production is growing. So freezing at the height historically of what they produce is really no sweat off their back. So in this instance, I guess, when Russia decides to participate and also try to convince other producers to freeze production, in the end it's for its own best interest.
Emma Richardson of BMI Research is also with us. Emma, hi, thanks for joining us. BMI, I was just reading a note from BMI Research, who believes that even if far-fetched any production agreement could be reached, it would actually do little in terms of any fundamental impact on the market is concerned, because OPEC members are already at their peak capacity. In this light, how do you explain this stance and the significance of this meet?
I think it has significance from a kind of sentiment-based perspective. We really don't see any possibility of them agreeing to freeze, but if they were to do so, I think that would restore a huge amount of faith in the market that OPEC was kind of taking up the mantle of swing producer again, and that effectively they were willing to put a floor under prices. So I think if you were to get an agreement, even though fundamentally it wouldn't make any difference, I think it would offer huge upside to prices. I think you could see crude move back towards $60 per barrel off the back of that swing in sentiment.
Right. Ged, you started the discussion by saying that you believe that we are heading maybe in a year's time into a completely new oil price regime or environment. Do you believe that we are in a prolonged period of range-bound crude oil prices? Over the next 12 to 24 months, what are your thoughts? Where could crude oil finally settle?
Well, I think there are a number of supporting issues that we need to think about. One of them is whether the sort of growth that people envisage, continually pushing north of 3% per annum for the global economy, is likely. I think there are big questions there. I think handling US tight oil as an example, and the possibility of other developments, comparable developments, is a challenge for OPEC. And then basically OPEC have growing populations, and at a time when their incomes are really decreasing substantially. And it's perfectly understandable that Russia would want to be putting itself forward as a member of a group that could possibly strengthen oil prices. But I suspect even if they go up to $60, $70 a barrel, you've still got to handle the change in situation of the oil market as a whole. So I would say that we've got quite a number of years in this present regime before we look at an increase in prices. And when it comes, it may well be quite large, as it's happened historically.
Emma, what's the role of Saudi Arabia? They have too indicated that if Iran agrees, they may also wanting to, or perhaps sit on the table to discuss production agreement. But we all know that Iran, the probability of Iran even walking in that direction is extremely low, given that they want to really maintain or increase their market share in the overall market. Then what does this commentary actually mean?
I think it's a bit of politicking on Saudi Arabia's part, to be honest. I think, as you say, they're perfectly aware that Iran is not in a position domestically, politically, to freeze its output, certainly not before it reaches pre-sanctions production levels. Relations between Saudi Arabia and Iran are obviously very, very poor at the moment, and I think this might be an effort on Saudi Arabia's part to shift the burden of blame onto Iran. They are offering to cut production, but they know that there's no way that Iran can subscribe to that.
Harry, that point about what Ged was talking about, that the price or where the agreement or talk between all these large players could head would depend on global growth, because that exactly tells us what kind of consumption patterns would be seen in some of the large areas. What are your thoughts? Which are the regions where growth may become issue even from current level or current estimates? Europe, US, you think?
No, actually, in our view here at BNP Paribas, the demand side is, I think, really secondary to the supply side. Since 2014, we've been living with a positive supply shock, so the market is going to adjust on that basis. If you look at global oil demand, and you try to tie that to global economic activity, the global economy is going to be growing 3% this year, probably a little bit higher next year, but that's sub the 3.5, 3.7 trend growth of the global economy in the 10 years leading to 2007. So really the focus here is on supply side adjustments, and as far as how the price is going to behave relative to that, it is a swing supplier of the market who's going to be dictating those prices. So right now, the swing supplier in the market, as Ged has mentioned, is U.S. shale oil. So the economics of shale oil are going to act as both the cap and the floor to this market. So we're looking at around $50 on the ceiling, and in terms of the floor, around $35.
Right. All right, Harry, Ged, Emma, thank you so much for joining us on the show today. With that, it's a wrap on this edition of Crude Reality, the special telecast we had for you on OPEC Meet this time round. Do tune in for more news and updates on the channel.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.